Hello and welcome to another episode of Angel Insights, the show that goes deep to the world of early stage investing. I'm your host, Tom Britton, co-founder of SyndicateRoom, and on today's episode, I'm delighted to welcome Aled Phillips, co-managing director of Niche Private Clients and Chartered Financial Planner. Aled and I are going to dive into the SEIS and EIS tax reliefs, as well as some of the scenarios in which one may or may not be better to use in your portfolio. But that's enough for me. Let's get Aled on the show. Aled, it's absolutely a pleasure to have you on the show today. Thank you very much for joining us.
It's a pleasure to join, Tom.
And for those that don't know, could you share a bit about your background? Because beyond being a financial advisor, you're a bit of an entrepreneur yourself.
Well, I suppose the journey to being a financial advisor was a path well trodden, but I joined Niche and my business partner, Matt, when they had built a piece of cash flow software, which became the most widely used financial planning software in the UK. And it was really at a point whereby financial planning was polarizing. There was the kind of the old banking model of charging a percentage basis, turning up once a year for a cup of tea, and thank you very much for the portfolio report. Whereas the industry was polarizing into those who were delivering proper financial planning, using cash flow modeling, really delivering lifestyle to clients as well as just a return, which is, really one part of the puzzle. So I joined Matt because we shared our view on financial planning, and we felt that the charging structure was not really fair based on a service provided by a financial advisor. We're very passionate about using technology to drive down cost for the consumer in a very transparent way. And we want to develop a strategy that will be attractive, particularly to entrepreneurs and to founders, using the cash flow modeling, using the software, and to ensure that we can wow our clients with an impeccable service, but also that they feel comfortable, they know what they're paying. And I think it's very important for them to know, because that's a real kind of sticking point and a lot of reason for such an amount of mistrust within the industry.
Fantastic. I think transparency and complexity definitely resonate with us as well. And clearly, on the transparency side of it, when we talk about SEIS and EIS, they are very risky assets. They're not necessarily right for everyone. And oftentimes they can become quite complex in terms of how you structure the tax, when you can claim the different forms of tax, the initial reliefs, the loss reliefs, the inheritance tax reliefs. So I'm very glad that you're here with us today to talk about those in a little bit more detail.
Yeah, pleasure.
There's a lot of resources that people can look up for EIS and SEIS, but if we do a quick rundown on the different types of relief and then go into when they're right for a client, in what situations and types of clients, I think that could be tremendously helpful. Let's talk about income tax relief. Now, the SEIS and EIS offer different amounts of income tax relief. SEIS is 50%, as we know, and EIS is 30%. I think what's important about these reliefs that people should know is that you don't get the reliefs immediately when you invest into the funds. And a lot of people who invest in VCTs, you get that relief immediately, but with SEIS and EIS, you get it as the deployments from the fund are made. And like certificates can take 8 to 12 weeks after you make the investment or after the fund invests in a company for you to get them. So for people who are planning for their SEIS or EIS for that initial income tax relief, how do you factor that into your planning?
The important bit is, as you mentioned, with the VCT, for example, you get the certificate immediately. But with a lot of clients on the EIS and SEIS, it's the other tax benefits, the business property relief, the capital gains tax, as well as the income tax. So for clients who are investing in an EIS, it's very important that they are prepared that, not only is the upfront tax and when the deployment is going to take place less predictable, and actually they may need to pay the tax to then get it back. but also that the maturities, are again far less predictable. So say for example, with the VCT, you know that at the end of the 5-year period, you're going to potentially get some liquidity, and then to be able to reinvest it. Whereas it's a far more staggered approach on an EIS, because you've got those maturities coming at when those companies are ready to exit.
How do you factor in the deployment time stated by the managers? Some say that they can deploy right away. Others give you a range of deployment time. How do you take that into account with your clients?
Typically, an EIS manager might say, we will deploy anything to 0 to 24-month period. So, okay, well, let's look at the worst case scenario, and as in nothing is deployed, in the first year at all. How would we make provision for that?
With the income tax relief, there is the option to carry it back one tax year. So you invest in this year, it deploys in the current tax year, but you can use it in the previous one.
Yeah.
When you engage with clients, are most of them planning ahead, or are most of them using it reactively for the previous year that they've just done their tax report?
Quite often with EIS, it's that they've got regular large income tax liabilities, and quite often we're not wiping all of it off completely, but it could be the case that it's over 3 tax years, because if funds aren't deployed for 12 months from the year that you're in, then they've got an option to deploy it later on using a number of tax years. Quite often we just have the conversation with the accountant where we're sitting down and say, okay, well, this is the amount that we've got so far deployed. Here's the tax certificates. Shall we go back to last tax year? Because sometimes obviously we're wiping out more than is available in the tax year. So it's just making sure that all the parties are fully informed and everybody knows exactly what is happening with the underlying investment and deployment.
You brought up a few good points there that we were going to touch upon later, but with the exits, with SEIS and EIS, your typical funds in their literature talk about 7-year horizons. But you and I both know that that's optimistic for most funds.
Absolutely.
And that for particularly SEIS. So SEIS, for those that aren't familiar, SEIS is the earlier scheme of the two. When you talk about SEIS investments, they have to go into companies that have less than 25 employees, less than 350,000 in gross assets. They have to be trading for less than 3 years. And if you look at the data on when those companies tend to achieve exits, some of the early exits might be year 5 to 7, but really the good exits that make the returns are more like year 9, 10, and sometimes longer than that, sector-wise.
Exactly.
As you pointed out, with SEIS and EIS, you can't really predict when the money comes back.
You're exactly right. You always need to make provision. I've seen a lot of clients where, because the tax reliefs are a 3-year period, they fixated on that number, but really it's kind of preparing people to understand this is illiquid. There's the risk of failure, and that's why in a client's portfolio, this should be an amount that is not needed for any capital expenditure, and we can easily demonstrate that by cash flow.
You're absolutely right with doing that. It's money that you don't need.
Exactly.
You should be able to tie up. And you did touch upon loss relief, which is definitely something we wanted to come into. So the loss relief is great in the sense that if a company goes bust and you've put SEIS or EIS into it, the amount that you still have at risk, i.e. the amount less any initial income tax relief you get, is open to receiving loss relief. Equal to that amount times your tax bracket percentage. The cool thing about SEIS and EIS is you can apply that against income or use it to offset capital gains. Now, most funds talk about potential returns, and they typically give a breakdown of what percentage of their portfolio is going to go bust. I'm wondering if you have an overriding percentage that you expect to go bust when you're looking at SEIS and EIS.
I think the discussion needs to be around, typically up to 30 to 40% can fail, and you have the real winners that really drive the performance and return the fund. However, be aware that there could be a particular vintage that there is no big winner in there, and then the fund is not returned, and the clients are prepared for that downside as well, and understand the reliefs they can claim. Because as you say, the neat thing about the EIS and SEIS is that you can claim it against your highest rate of marginal tax. So if you had an amount that was going to be offset at 45% against income, and then there was also a property gain after that. There was the next, so it can cascade downwards, and you can offset basically as much tax as possible. But I think that with regards to the EIS, it's very important that people are aware that it could fail completely, and that's why I'm a firm believer that SEIS and EIS investing is not a one-off. If a client just, if it's just one tax bill and one event, I'd seriously question whether or not it was suitable, because it's something that you need to be building up over time and building up your allocation to it. That gives them the greatest chance of success the longer term.
And you're absolutely right with that. I mean, we've obviously published a paper about the power law and trying to build your portfolio up to 150 holdings, extend it, and doing that over multiple years, because as you said, there are vintages in these years. You've got the good years and the bad years. So you do have to view it that way. I will note, though, that you talked about a property sale. And of course, a property sale does give you, a capital gain that you have to deal with. And between the SEIS and the EIS, the schemes offer different forms of relief for those capital gains. So with SEIS, you have SEIS reinvestment relief, which allows you to take a capital gain, put it into SEIS, and reduce the capital gains tax that you would pay on that by half.
50%.
Yep, 50%. Where with EIS, you can take a capital gain or part of it, put it into EIS, and you're effectively deferring that gain until the EIS would crystallize. Do you utilize that much, or because of what you've said about it not being one-offs, do you tend to, I mean, of course, you're going to take advantage of it if it is a situation, but you're not just looking for that kind of scenario?
Yeah, I think just looking for that scenario, the clients who've got those large gains to offset have usually got enough income tax, and you've got to claim some income tax relief to be able to get the tax-free return in future. And with deferring a gain, it's very important that if you deferred it across, if you've deferred it across 50 companies, for example, that proportionally that gain would become payable. So the client knows that when that's realized, how much of it is gain and how much of it is then profit. Because we've had instances where the original investment might have been quite small, a company's done particularly well, it's been the star of the portfolio, and then actually, he or she has taken the profit and then just reinvested that initial amount that the gain was deferred into, continually kicking that down the line effectively. And then also to pre-warn them that, if capital gains tax rates changed in future and they needed to realize it in full, that they may be suffering a higher rate of tax down the line.
Because you're paying it when the amount of when it crystallizes, not of when you go in.
Exactly. So again, which has been particularly topical recently. Now, in examples, we haven't seen clients where they've said, "Oh no, I don't want to defer the gain," even when they believe the CGT is going to go up, because it's they've just said, "Okay, well, we're just continuing to cycle that in." But it's very important that they clear at outset, because you don't want a nasty surprise. There was talk not too long ago of the capital gains tax rates being matched to income tax rates. So, it could have been somebody who has gone from 20% to 45%.
I know there's a lot of factors in choosing between SES and EIS, but when it comes to the capital gains, for a client who's looking at it for that one-off, and I know that you don't like to do that, but if you're looking at it for that one-off, because there might be somebody listening who's looking at it, in what situations is it preferable to take the half reduction that SES offers versus having to go through the admin of either paying it later or continuing to roll it into EIS?
We are dealing with far more complex investments here, not only on the risk return basis and the understanding of that, but also on the tax side and the administrative side of it. So even though in this instance, the tax incentivized investment is a very important discussion, I really wouldn't think about it as in, should we use one or the other? An EIS would sit alongside an SEIS because of the risk profile of it.
Does a person's age play any role in this decision-making process?
You could have a client in their 60s. You need to have the conversation up front and say, some of these companies might not be maturing until you're 78 years of age, and do you really want that kind of the admin and the complexity? And, might say, absolutely, that's fine. But it's very, very important to consider that.
Obviously, these are long-term investments and they are very risky. However, what would you say is the right age to uh, start considering SEIS and EIS investments? Obviously, you have to have a level of income because you can't
Yes.
afford to lose it. And most of the funds are, 5, 10, 20K minimums. So you have to have a little bit aside. But
Mhm.
at what point in your career should you be thinking, actually, instead of doing my full, say, 20 into my ISO, um, maybe I should put a little bit over here? Or
Yeah.
is there
That's very much led by having enough disposable income. This is money that you can afford to basically tie up and not worry about. And if you never need it again, then great. And usually that is later on in people's careers. But we see regularly clients whereby they've sold a tech business in their 20s, and actually it all fits the bill because they're entrepreneurial in nature. They understand the risk and return. They've got a higher appetite for risk, and they've got all the tax reliefs available. So I would say it depends more on the client themselves and what they're looking to do. But again, always keeping a very clear um, a line in the sand, if you like, with regards to what is surplus and what's never likely to be, and the money that they can afford to lose completely. It's in that kind of 5 to 10% of net worth bucket where people can just forget about it. And usually we tend to see clients who are at least in their 40s who are suitable for it, but it's just because of their financial position rather than the age.
on the other end of the spectrum, how do you approach someone who's later in their years in talking about these investments and think about it?
Yeah.
As we touched on before, there are IHT considerations with both SEIS and EIS that come into play. And for
Yes.
those that haven't read, of course, IHT rules have changed, but SEIS and EIS still qualify through BPR or BR, depending which acronym you're using. So when it's kind of a sensitive subject, but thinking
Yeah.
about IHT.
Yes. So again, so sometimes it's having a very frank conversation and saying, actually, do you know what? It may be that maybe you won't be around when some of these companies mature, and people actually understand that, and they say, well, actually, when I'm investing in this EIS, it's likely that it would be my family administering the EIS after my days. Now, again, it depends on the type of client too, but there are other BPR investments that are more predictable, if you like. There's not an unknown quantum with regards to when they can be realized. So we've had clients say to us, "Oh, you know what? I wouldn't want to leave that for the family to deal with. If I wasn't here."
On that, and side tangent to that, when you get to your later years, you start to think about legacy, and as you mentioned, what you leave behind and what you want to be tidy versus less tidy. How much of a how much of an impact does what is being invested in, not like, EIS versus an alternative, but what actually that is going to invest in plays a role in decisions around that time? Are you seeing from clients? We're seeing a lot more with our own Carbon 13 fund. It's about climate tech. We're trying to do some more of these
Yes.
impactful funds. Has there been a change with clients
Um,
in what money's going into?
I think there has, and certainly with the next generation, where maybe wealth is across three generations, and the, the view of the importance of ESG, the money doing some good, and with EIS, because by nature of investing in technology, and there's lots of medical science and green technology that is coming from this, and people have a real good feel good factor about that. And I think that it's because a lot of those innovative companies do kind of just by nature of the opportunity fall under that ESG label, even though there's a lot of greenwashing in our industry, as you know. But they do kind of tick those boxes. it has definitely become something that is more important to the next generation. Now, you could argue that, okay, aren't they in the fortunate position that they can have that view and not worry about it, having a detriment to return? But I think that it is a conversation that we've had far more, and where it's come upwards for the family, where sometimes the children or the grandchildren are asking, what types of opportunities are they investing in with regards to their ESG credentials as well. So yes, it's definitely coming a more prevalent topic.
Absolutely, and we're definitely seeing more of that, as mentioned before. Now, I think we've covered quite a bit, but I was wondering if maybe we could look at this from the perspective of someone who's not done an SEIS or EIS before, and if we could quickly summarize what should you take into consideration. You've already mentioned a few things like treat it as a long-term, don't think about it as a one-off, but when you're speaking to someone who's not done an SEIS or EIS before, how do you usually approach it with them, and what are the key things they should be aware of?
Okay, so the key things, I believe, are the lack of liquidity, which needs to be clearly explained, on that this is not an investment, like a listed investment where it's got daily liquidity and you can trade in and out of it. That there needs to be a clear understanding of the tax reliefs and actually how they can absorb, quite a bit of the downside that come with these investments, and also the types of companies that they're investing in, where they are within the cycle, what type of size they're after as a typical company, what type of check size has been written, and also to run through how EIS managers invest, that they co-invest with others, and then the different strategies of the manager themselves. And I think it's just being very, very clear about it, that it's higher risk early stage companies, that these are not stable, long-term revenue generating, profit generating companies. These, especially with the SEIS, where it's gone beyond the idea phase, but you are very, very early on in the journey. So I think with all of that is just managing expectation and just making sure that it's kind of being committed to a long-term allocation and strategy, rather than just, as in this is going to play a small part in the overall piece, and these are the tax benefits it's going to generate, and actually compartmentalizing the amount that is going to be allocated to this type of investment, so that they're very clear on where it fits in their own finances as well.
Solid advice, definitely. So for someone who might be considering doing this investment and they're still a little bit unsure, how might they get in touch with you and your team?
So they can contact us directly over the phone or via the website.
And what type of client do you typically engage with?
Well, typically clients of £1 million of investable assets and above. Entrepreneurial clients are the vast majority of our client base, where they're coming towards an exit, or they have sold a business, or they've come into funds from an inheritance, etc. That tends to be the vast majority of our new client inquiries and our existing client base.
Excellent. It's been absolutely fantastic having you on the show.
Absolute pleasure, and I look forward to catching up soon.
Well, that's it for this episode of Angel Insights. We hope you've enjoyed the show. If you'd like to find out more about what Alid and the team at Niche are doing, please head to www.nichepc.co.uk. And of course, if you'd like to learn more about what we do at SyndicateRoom, please head over to www.syndicateroom.com. Thanks for joining, and tune into the next episode. We'll see you then.